This is Michael Fisher for savingandinvesting.com, and I'd like to speak a little bit more about the other type of pension plan, which is known as a defined contribution plan. Defined contribution plans have become very widespread and are a much more common form of pension plan available today, particularly in the private sector, i.e. from companies. In a defined contribution plan, contributions are paid into individual accounts on behalf of the plan members, i.e. the person who has the pension plan. And the retirement benefit that's accumulated is determined by the amount that's contributed and by the investment return of the money that while it is held within the plan. So in other words, as we work, we contribute money into this pension plan, and the more we contribute, the more we'll have when we've contributed it, and the better the returns are while the money is within the plan, the more money we will have at the end. And the advantage of this type of a plan is that the risk no longer lies with the employer, i.e. the benefit is not defined from the employer's standpoint, and there's no commitment to pay a certain amount. On the other hand, and from the plan participant, from the person working, the benefit to some extent is that they can choose how much they want to contribute or how little, and also have more insight and say into what the investment alternatives should be that are in the plan, i.e. stock mutual funds, bond mutual funds, index funds to some extent, and have a bigger role in determining what the outcome is for the fund. And because it is an individual account, the plan is effectively fully funded, i.e. the money is there and one can watch it either grow or shrink depending on the returns that take place while the money's in the plan. These types of plans are typically offered on a tax-advantaged basis, such that money that goes into the plan either by the plan member, i.e. the person working, or the employer, it goes in on a tax-advantaged basis, so perhaps one does not have to pay tax on the money that goes into the plan and accumulates tax-free as long as it's held within the plan for a certain amount of time or to a certain age. And then when it's taken out, typically income is lower, i.e. the person is in retirement, so or has passed a certain age, so the money is taken out on a much lower tax basis. 401k and IRA plans in the United States are types of defined contribution plans where money is put in and the returns and combined with the money that is put in determine how much money is there upon retirement or at any certain point in time. The other advantage, arguably from the plan participant's point of view, is that what has happened with some of the plans in the private sector that were defined benefit, i.e. plans that were offered by companies that were defined benefit, these plans can end up underfunded, which means that there aren't enough assets to honor the benefits that were effectively defined when the person was working. So in other words, they're underfunded in the sense that the capital isn't available to pay out what actually is supposed to be the defined benefit, resulting in an underfunding situation, which creates obviously a lot of stress for the retiree, but also creates a financial mismatch for the company. In the case of a defined contribution plan, this type of thing doesn't happen because the amount of money is in an individual account, and although the benefit's not defined, given the amount that is contributed and the investment returns that are actually taking place, the amount that is received is clearly known based on those real facts, and there's no underfunding per se. In the case of defined benefit plans that are offered by the government, it's less likely that they'll be underfunded, in that one always assumes that the government can always raise money. But certainly through taxation, for example. But in the case of the private sector, where certain large companies have seen their businesses decline, their number of employees decline, their number of retirees increase, their profits and revenues decline as well in some cases, defined benefit pension plan underfunding can become an issue, and that is then of course a risk for the employee or retiree ultimately. So defined contribution plans are plans of the type of 401k or IRAs where individual accounts are created and money is placed into them, and that the amount of money and the investment returns determine what the benefit is at the end of the employment period or upon retirement, and then one can decide what to do with those with that accumulated capital. This obviously places also some more onus on the employee to make contributions and to potentially have some say in selecting the investments, which makes a further case for financial literacy, diversification, and understanding of financial matters. And because more of the responsibility clearly lies, in this case, with the employee. With a defined contribution plan, there is more of an onus on the plan participant to pay into the fund and arguably to also potentially play a role in selecting the investments. Having said that, that also means that control also means that there's more transparency and better visibility on how much money has actually been accumulated for that specific employee during the working period.